Okay, welcome everybody. This looks like it's going to be a jam-packed call today. I did upgrade our Zoom room, so now we have up to 200 people that can actually be visible on the Zoom, so that's exciting because we are maxing it out at 100. So I want to welcome today, we have a very special guest that Onyx has brought on. This is our Tuesday morning Zoom meeting that we've done every single Tuesday morning at 9 a.m. Pacific and 12 p.m. Eastern time since Onyx and I launched this team. It's our business builders team, and it's place for us to add value to your lives, both in building your business and your finances. So we have a very special guest today. And Onyx, do you want to do an introduction for him?
Absolutely. Thank you, Kathy. So welcome, everyone. I hope everybody had a beautiful Memorial Day. I think I saw Bart come on from Sweden. So welcome, Bart. And I've seen so many nice faces, familiar faces. It's great to see you all each Tuesday. Anyway, today we're not going to be talking about X39 at all. I want to introduce you all to a very different concept. The reason I asked Chris to come on is because we are, most of us, serial entrepreneurs, and having a retirement plan for serial entrepreneurs is often very difficult. I think you all are really going to like this concept, and beyond that, many of you, like me, have children in that sort of 18 to 24, 25 age range, and this is a wonderful age for them to start in a concept like this. So I don't want to steal any of Chris's thunder. I'm sure he's got lots to tell you, so I'll just turn it over to Chris.
Hi, everyone. Thank you for having me. I appreciate you inviting me to the call, Onyx. Thank you so much.
My pleasure.
How much time do you have for me, Onyx? I just don't want to step over or make sure I'm consolidated in the right way.
I would say, if everybody's okay, let's go for 45 minutes. We usually keep these calls to 30, but I think the content is going to be so interesting to everyone that they're going to want to be able to hear what you have to say.
Okay, awesome. Thank you. Well, again, hello, everyone. My name is Christopher DeYoung. I am out of the great state of New Jersey, just starting to open up and quarantine now for the last 2 months. So it's nice to see so many people's faces. It feels like I'm actually out and about for a second. So today I'm going to be discussing some financial topics with you. And I have been for 20 years helping wealthy families.
She tried to get me to go to her house for dinner. I said, yeah, that's a possibility. I never did it.
Bart, you got to mute yourself. Bart, you got to mute yourself, please.
Bart, if you want to take me for dinner, no problem. That sounds good. So for 20 years, I've been helping families in a very particular way. When most people think about financial planning, they all have advisors. Most of us interact with many advisors on a regular basis. We have financial planners, we have accountants, we have mortgage people, we have bankers. Generally speaking, I'd fall off my chair if a lot of the people that I had dealt with didn't have anybody that they were working with. I work in a very particular way. I don't replace the people that are already in somebody's life. I am more of an efficiency expert. I come in and I look at the big picture of somebody's financial life, and then I put very specific tools in to make them more efficient. The best and easiest example I can give you is that we're all really building a financial house. And throughout our lives, we interact with lots of subcontractors, electricians and plumbers, and all the different people that help us build our house. And in essence, as individuals, most of us are trying to build our own house on our own. And then somewhere along the line, we have a good friend or someone we trust who is an electrician, and we give the whole job over to the electrician. And when you do that, what happens is your electric is going to be perfect, but when you flush your toilet, your irrigation system is going to go on because that person didn't do any of the other things. So we tend to, as business people, because we're so dialed in on our businesses, we spend so much time trying to build our businesses. And when we're not doing that, we're usually spending time with our families, that we tend to piecemeal our financial life together. And we lack time, we lack focus when we're not working. And we tend to create what I call the junk drawer approach to planning, where we have a bunch of stuff in that drawer. And some of the stuff is great and some maybe isn't. And we're not really sure if those batteries work or not. And that's how most people plan for their entire financial lives. Well, I'm more of a general contractor. What I help people to do is organize all of their people, their life, all of those mini strategies into one blueprint. And I help to make sure that all of the subcontractors are actually working from the same plan, and that, you know, the drywall guy is not going to show up before the electrician, and you're not unnecessarily losing lots of money because you're doing things in the wrong order. And I've been doing this for a very long time at a very high level. And I have learned some very particular ways of planning that make people more efficient. So I'm not going to go into the million different things that I will talk to with my clients as 45 minutes. Normally I can't introduce myself in less than 30 minutes. So having 45, I want to keep it pretty concise. So Onyx asked me to speak in detail about some life insurance planning, and specifically some things with regard to the infinite banking concept and how to use life insurance as a banking planning system. Some people have heard of this, some people have not. Most people, when they think of life insurance, they probably wince a little bit and shake their head, and they don't even want to think about it, nor think about the people who generally aren't involved in it. But life insurance, as we know it, has been around for a very long time. It's basically, when most people start to really get into it and look at the values of it, first off, why do people not like it? Well, generally speaking, people have been sold products their whole life. They take opinions from everybody, and they're constantly sold and resold. So they might have been sold something, it didn't work out, and then they wind up not liking it and had a bad experience with it. And some people just don't understand it. They don't understand how it works. Why would I even want to have it? It's got a low rate of return, and yada, yada. What I find is that most people don't actually understand its true value and purpose beyond dying. And they look at it more from the standpoint of it's something for somebody else, and it's when I die. And in some instances, obviously that's true. From my standpoint, I look at it and say, well, would you want a product that is one of the only products that has basically remained materially unchanged for roughly 250 years? And most people don't actually know the first insurance company was actually the East India Trading Company, and they would offer some form of insurance on the sailors. And it's been materially unchanged for all of this time. About 60% of the product is acquired by a demographic that represents about 10% of the population. Most wealthy people and people who have money are the population who are actually buying insurance, especially the kind that I talk about. It provides a pretty competitive rate of return, historically hovering around 4%, though when you combine it with other financial products, it can actually enable a person to achieve double-digit rates of returns. For people who complain about taxes, there are no taxes on the accumulation. The return is 100% tax deferred, has a basis, and under some circumstances can become tax-free. So it's a true net rate of return. It reduces and has zero volatility. The assets can only go up in value. While not totally, it's predominantly guaranteed. And as it goes up in value, there's a new and higher floor as you add more money to it. You have collateralized access to the cash in the product at among what could be the lowest rates of return in the market. And it's not callable. Effectively, it enabling me to reuse my money if it makes sense to do that. And this is the part that I'm going to really elaborate on in a little bit. In some instances, when you put a couple of riders on the product, if for some reason I became disabled, the financial institution that gave me the product promised to continue to contribute to it on my behalf until retirement. Depending on the state that I live in, it's entirely or partially protected from all creditors and even bankruptcy in some instances. And the only thing it doesn't work well with is the government, because they'll take whatever they can. In the event of an untimely death, it's self-completing. If I don't make it to retirement, the company that gives it to me, they promise to deliver the end result to my family or person of choosing, completely income tax free. Because of that self-completing nature, it can eliminate the necessity and cost of some other financial products, and can actually enable you to recapture costs and become a little bit more efficient in how you consume or redeploy into other financial instruments. It behaves like a discriminatory, non-qualified retirement plan, exactly like the ones that are set up for upper echelon C-suite executives of major corporations and banks. And insurance is actually one of the main vehicles that they use for those golden handcuff kind of packages that these CEOs get. And from my look at it, and 20 years and being in every single aspect of finance, growing up in a family business, and I invest in real estate, I have a ton of businesses on my own. It's one of the best retirement, estate, generational planning vehicles that is in existence today. It maximizes retirement income, estate transfer, and general wealth while minimizing taxes and risk. It's a guaranteed increase in money supply to your balance sheet, and can generally help people retire sooner, retire more efficiently, and can always help reduce taxes in retirement and have more money flowing through your hands. And what we like to use is a banking concept that can help provide alternative sources of income or leverage in any market conditions. And we're going to really hone in on that. It can provide for tax efficient and in most cases tax-free transfers of wealth to the next generation. And it's very, very liquid to you and to your estate at any given time. And hopefully I'm not boring you, but I kind of want to cover some of this basic stuff in general so that as I'm going over some of the other topics, you can have a decent understanding of what I'm talking about. So given all that I just said, why do most people hate it? And what I find is that most insurance is not set up for the consumer. It's set up for the insurance company. It's set up for the insurance agent. There are large commissions in it, and people know that, so they get into the business so that they can make good money. And in most instances, it's never set up for the person buying it. And that's generally why people don't really like it. It's never been explained well enough to them of the value of it. And it's never been set up for them, set up to take advantage of all of the benefits that it provides. And when most people think about life insurance, they generally think about price. You know, they'll say, well, you know, why can $1 million of term insurance for one person cost $600? And then I hear other people that they're spending $50,000 on a policy. And that's generally, and then they'll say, well, if it's the same thing, why is one $600 and why is one $50,000? And in general, it's because they're not the same thing. Most term insurance prices are set up by the insurance company. The company sets those prices, and they're generally relatively cheap. You know, a 40, 45-year-old person can get $1 million of insurance for something like $500. Well, if that person went to go get a whole life policy, that same policy might cost $12,000 or $14,000 or $15,000. And if you think about term insurances, they're set up for the insurance company. It's less than 1% of any term insurance actually pays a claim, which is crazy when you think about it. So you have all of these people paying all of this money, and most likely none of them will collect on it. Now, we all know, obviously, some of those unlucky people who drew the short straw and passed away young in life, but the odds of that are extremely, extremely low. And the insurance company makes most of their money on term insurance. That's why you can't turn on an AM station anywhere in the country without hearing 15 ads for term insurance and price and everything else. Most people don't understand that there's actually a high number that you can put into insurance. You can't just put as much money as you would want into an insurance policy. And on the term side, where the term insurance company actually sets the lower limits, who do you think sets the upper limit on what you can put into an insurance policy? And I know everyone's muted, so I'll just give you the answer. It's the IRS. So the IRS actually creates the limit of how much money you can put inside of insurance. Why would the IRS be concerned with how much you can put into an insurance policy? And that's because in 1934, a rule was passed that made insurance predominantly tax-free. And it's tax deferred, but under most instances, if you use it properly, it's tax-free, and the death benefit's always tax-free. So the IRS puts this limit on there because I always say the government, although slightly dim-witted, they're not stupid. And in the early 80s, what they figured out is that people were buying life insurance policies and buying $100,000 policies, and they were dumping millions of dollars in cash so that they can take advantage of the 1934 rule. So what happened is they put a limit on what you could put into this type of plan. So what I do and what I help people to do when they're structuring policies is I help them to actually maximize that contract right up to that IRS limit. And when you do that, in essence, you can actually create a product that is designed for you and not designed for the company, not designed for the agent. And if you set it up properly, most of those big commissions that everyone, hates to hear about that the insurance guy is making or person is making, you can take that down to a pretty low number compared to what you're putting into it. In a lot of instances, we can show people how normally in a traditional kind of insurance policy, the first year, there's no money in that policy. You put $1 in and there's nothing in there. And the way we structure policies is we teach people how in the first year, they can have somewhere between, on the low side, 50%, on the high side, 85, 90% of their first year's contribution in that policy. And when you do that, you're immediately beginning to make the dividends that the company puts out, and you're making interest. And more importantly, you then have access to that money. So again, I'm giving you a background so we can kind of understand these types of instruments and how they're used. And what happens is most people, they hear about lots of different kinds of insurance. They tend to take the 20 different kinds of insurance that they know of, and they actually create one policy in their head. And in essence, they're taking 20 different kinds and they're morphing them all together. And for our conversation, really, there's only two types. There's a term insurance policy that we talked about, which is like renting an apartment. You rent it, you sign a lease. At the end of that lease, you leave it, you don't get anything in return. A whole life policy is like owning that policy. When you own a whole life policy, the insurance company actually has to take a percentage of that death benefit and carve it out in their reserve pool. And because in essence, if you make those payments, they will pay that policy. They'll have to pay it. So they have to plan for that. And what starts to happen is that people like to look at these hybrid policies. So if a $1 million whole life policy was $12,000 a year, there's like 15 different other types: variables, universals, indexes. Anything less than that 12,000 is the insurance company taking the risk from them, and that they will have to pay that policy, and they're putting it back on the consumer. So anytime you're paying any less money than what a whole life contract would be, and I won't spend too much time on this because, it's like starting to talk about way too in detail, complicated stuff. But what happens is that the insurance company doesn't have to put those reserves aside. And in most cases, those policies wind up lapsing or going away over time. In my 20 years of doing this and doing estate planning in Manhattan for many years and working on some very, very large estates, if this gives you an example, I've never seen an old indexed universal, variable universal life policy, ever. Most of them are gone. The only time we see insurance that's been around for 30, 40, 50 years, it's always a whole life policy. And I want to use insurance because it has no risk. I want to have a place to put money that is completely not correlated to any of the risk that I'm going to put and take anywhere else in my life. As entrepreneurs, we take risk in our businesses. We take risk in real estate. We take risk in pretty much every other place of our lives. I want to use this one bucket as a place to not take any risk. And to me, that's what makes it valuable, is that it's not risky. So with all of that being said, how and why do I want this policy in my life? What is the value of it? Well, off the quick look, what does it mean if I have a death benefit in retirement? Why would I want a death benefit in retirement? In most cases, if I've saved enough money, most people will say, well, why do I need insurance? I have enough money. I've saved enough. My kids are out of school. My house is paid off. What the heck do I want insurance for? And the real reason why is because it is a tremendous replacement vehicle. It replaces assets. And if you think about it, if you retired with X amount of money, that money has to last what could be a very, very long time. It might have to last, in this day and age, 30, 40 years of retirement. And that's a long time for any amount of money to keep its value and to be around and to be able to live off of a good, comfortable income with healthcare and all the other things going on. Not to mention, if you've been paying attention to all the government stimulus and everything else that just went on, we just printed about $4, maybe $5 trillion. And 10 years ago, we printed another 2-3 trillion. At some point, interest rates are going to have to rise, taxes are going to have to go up, and we're going to have to pay the piper at some point. And most will be the next generation, and kind of over the next 20, 30 years, there's a very, very high likelihood that the money is going to get expensive. Sorry, I'm seeing some of these notes pop up, and I'm trying to look at them at the same time I'm talking to you, which I shouldn't be doing. But if I looked at my retirement and just off the cuff, and I said, all right, I have a husband and wife, and they're going to retire, and they have $1 million in assets, there is a tremendous amount of pressure on that $1 million. It needs to provide for long-term care. It needs to provide 2 lifetimes with income over what could be a 30, 40-year retirement horizon. It has to keep pace with inflation. It has to take care of taxes. And if you have a death benefit that is going to pay when you die, what it in essence means is that it takes some of the pressure off of that money. It enables you, in essence, to spend more while you're younger and healthy. And I always joke and say, while both knees and hips were working, you can spend more, because when the first person dies, you know there will be a replacement value that will, in essence, replace the assets that have been spent. And if you just get one thing out of this conversation, is in retirement, if you have replacement of assets so that when one person passes away, money floods into the estate and replaces what had been spent, it gives you a ridiculous amount of options of how you can spend your money, how you can do charitable and tax planning. And in most instances, it would take whatever retirement nest egg that you have saved, and it would make that money go 50 to 100% more than if you didn't have that replacement value. And how to combine strategies to maximize cash flow and spending in retirement. That in itself is a very long conversation, but I kind of just want to build out on this whole talk so that you're seeing some of the different aspects of this. For our conversation today, we're going to talk about what are the wealth building assets of insurance. Like what are the characteristics that make it a good, viable thing while I'm young and I have cash flow and I'm working. And let me preface this by saying, at no time do I think that insurance should be the only thing that anybody should own. I think it's a component of a lot of different things. I look at products as tools, and I can't just have a screwdriver in my toolbox, because most likely at some point I'm going to need a hammer or a wrench. But when I put all the tools together, I generally will have a whole lot more options on what I'm able to do with my toolbox. And the biggest problem with insurance is most people walk around not understanding the job that the tool does. And I'm an analogy person. I'm always giving examples. And if you understand the difference between a Phillips head screwdriver and a regular screwdriver, you know, the Phillips head's the pointy one, the regular one's the flat one. Well, if you spent your whole life trying to use a Phillips head to unscrew a regular screw, a flat screw, you would think that screwdriver was the most worthless tool that there was. But you were using it for the wrong job. So it wasn't the tool that was the problem. It was how you were using it. And insurance, in most instances, is the same thing. People don't understand how to use it. So let's get back to this structuring of insurance. So what I try to do with my entrepreneurs and my business owners is I allow them to take a look at insurance from a very different angle. One that kind of looks at the product from all of the different values that it brings to the table. And it's one of the very few products that can do an awful lot of things at the same time. In essence, it gives you protection, asset building, it gives you liability protection, cash flow, all in one product. It's one of the only things that actually does that. And it's like a Swiss Army knife of products in that I might not need a spork, but when I do, it becomes a valuable thing. And that's kind of how I look at it. So as I look at all of the things that most people are putting money into, most of us are business owners, entrepreneurs, and as we're starting to look at the vehicles and the tools that we're buying, most of us have some kind of a retirement asset, 401k, IRA. We might look at Roth IRAs. We might look at real estate. We look at a whole combination of things. And one of the things that I would like to say is that you should always have a certain part of your toolbox that is in permanent, vanilla, whole life type of insurance. And especially the way I do it is I overfund it to get up to that IRS guideline. And once I start to put some money in there and it starts to accumulate, now it's not ever going to be the biggest rate of return you're ever going to get. To look at something that's going to make 3 or 4%, obviously I can make more money in my business. I can make more money in real estate. I can make more money in the stock market. Most people aren't buying it for a rate of return. They're buying it for all of the benefits in combination with each other. And although, especially these days, a 4% guaranteed tax-free rate of return doesn't sound that bad right about now. Once I'm starting to build some cash flow into it, what is this banking concept? And people hear leverage out of insurance, and how could I use my insurance policy to create more wealth? And it's a very, very interesting concept. Most places that you're going to put money, they're going to come with some handcuffs. They're going to come with some rules. They're going to come with, something that's going to affect my ability to use that money. Take a 401k or a SEP plan. If I was jamming a ton of money into some kind of retirement plan, I have very limited access to that money. In a 401k, I can only maybe lend on it if it's in service up to 50,000 or 50%, whatever is less. If I want to pull that money pre-59.5, I have to pay all the taxes due all at once and plus a 10% penalty. It's not a very liquid asset. If I want to take money from my stock account, well, I'm going to have to exchange whatever I was making in that account, and I'm going to have to move it to a different account. So if I was making 10%, I'm giving up 10% to go someplace else with the money. That becomes my lost opportunity cost. And maybe my timing isn't correct on pulling that money out. I mean, if anyone's living in retirement right now, it's not a very easy time. If you just lost 20, 30% of your value, and now's not a great time to take money from that account, I'd rather have that money sitting and have a chance to recoup the money that I've lost. So what I look for is something that's very liquid, something that can help me create what I call war chest or cash reserves, has no risk, has tremendous amount of liquidity on it. And using that money for other more lucrative things. Now, to understand banking, you have to understand, why do banks make so much money? Have you ever think about that? Like, why is there a bank on every corner? Why is every stadium named after a bank? And basically it's because they literally print money. They use our money to create more money. And let's just give a simple example. Let's say I have $100,000 in a money market account at Wells Fargo. Now, Wells Fargo has to be a bank, they have to have a bunch of reserves and a bunch of money in their reserve pool. And the more deposits they get, the more money they can lend out. And it's a big fancy calculation, which we won't get into. But so let's say I have my money there and I give them my 100,000. And what are they paying on money markets these days? If I'm lucky, maybe 1%. Maybe I could see a little bit higher than that, but let's say 1%. So I gave them 100,000 and they're giving me $1,000 for that 100,000. But now they're able to lend out their reserve pool and lend out a portion of their reserve pool to somebody who needs a business loan or a car loan or any kind of loan. And let's just for illustration purposes, let's say they can lend out my 100,000 for 10%. So they're paying me 1%, they're lending out for 10%. So what's their profit? What are they making? Some people will say, well, they're making 9%. Well, that's not true. So now let's follow the math on this. Their cost of money was 1%. That's $1,000, but they're charging 10%. So they turned $1,000 cost of money into $10,000. If you do the math on that, that's like 400%. So they're making 400%.
So Chris, it's
Yes,
on
please.
Onyx.
Hi. Hear me, Onyx?
Yes. I'm thinking that we've got about 15 minutes left, and I am listening to you and don't understand the product that we're talking about at all. And while your data and information is extremely important, I don't think everybody will understand what the product is. So I'm wondering if we don't either do a question and answer, or I ask you some specific questions specific to the product so that everybody can learn just about the product as opposed to all the other stuff. Does that make sense?
Totally makes sense. I know I'm being long-winded, but I was trying to give
okay.
a lot of background information so people can understand it. And
I totally
put
get
it
it,
in
but because we're
context.
sitting in front of a computer instead of with each other, it makes it, for me, and my dyslexia, I guess, it makes it more difficult. So this product that we're talking about is called a whole life policy, correct?
It is. It's actually a vanilla, simple whole life policy, but we're overfunding that whole life policy up to the IRS guidelines and putting as much extra cash as they will allow us to put in before we trigger a tax.
Okay. And that, so we might put $10,000 a year, we might put $30,000 a year, we might put $50,000 a year. It's totally our own choice when we set up this policy, correct?
Correct.
Okay. And so then the money that goes in will produce a death benefit for us the first year that we go in, correct?
Yep. From $1, you have a death benefit associated.
And what I understand is you can also loan against your own money. So many people that utilize these sorts of products, rather than go get a car loan, will actually loan their own money from their whole life insurance policy. Is that correct, Caddis?
Yes. So as my cash value accumulates and as I have more cash inside of my policy, what the idea is instead of going to a bank for funding, whether it's as small as maybe a car or something like that, or in some instances, people will finance real estate or buildings with their own money. So in essence, as they have their money in their policy, making right now maybe 4 or 5% free with no risk, they can leverage the value inside of that policy via a bank. And generally right now, the interest rate is about 3% payable to the bank. So if you follow, my money is inside the insurance company making 4 or 5%. I'm borrowing it for 3%. And now I'm financing my own car, house, or private money, hard money lending. And I'm charging myself the interest rate that the bank would have charged me. So if you follow that, my money's making 4 or 5, so I'm borrowing for 3, so I'm already making 1.5% or so. And then let's say I charge myself 6% to use my own money and pay back an amortization schedule, just like I was going to pay back to the bank. And now I'm making 7% guaranteed on my own money for something that I was going to do anyway and just give the bank the money.
So for me, everybody on the call, this is an incredibly powerful way for you to leverage and to continue to have a safety net for yourself. The other thing that I see with this is, as entrepreneurs, it's difficult to find a place to create a retirement plan. And so, correct me if I'm wrong, Chris, but with this product, you have a certain period of time that you can pay in, and then you can start taking the money out for yourself for your own usage in your own retirement. Is that correct?
Correct. Generally speaking, there's a couple of different ways to utilize it, but in its simplest terms, if I didn't want to utilize the insurance aspect of it, and I just wanted to use it as an income stream, at some point in retirement, you can, in essence, annuitize the whole entire life insurance contract and pay yourself an income stream that would be tax-free throughout retirement. That would most likely, you would never outlive it.
Correct. So this is the same sort of insurance policy that Walt Disney used in order to fund Walt Disney World, correct?
Yes, everyone thought Walt Disney was a kook and that his idea would never work. So he, in essence, had to collateralize his own whole life insurance policy to get the financing for Disney World.
And one of the questions I'm going to tell you guys that I asked Chris is, when he got his first policy, how old was he, and does he still have it?
So my first policy was actually when I was 22 years old, and I still have it. And I've been putting $365 a month into that policy for over 20 years. And that policy at this point has only gone up in value. It roughly has close to, I think, $175,000, $185,000 of cash in there that went up by 5.65% this year. No tax, no risk. And I've borrowed out on that policy probably 10 different times and have done a million different things with it. I always joke and say I bought my wife's engagement ring with it, so the rate of return is infinite now. And bought real estate and financed and all different kinds of things with it. So yeah, absolutely.
So those of you that have kids that are in this sort of 18 to 25-year-old range, this to me is a wonderful place for them to get their lives set up and secured, rather than putting money into a savings account, which, like my own daughter's like, Mom, I made 66 cents. I mean, it's an absolute waste of time. It gets them operating in a correct activity. It teaches them discipline. Of course, it gives them a death benefit, which, probably won't be relevant for any of them, which is great. But it will give them the opportunity as they get older. You can borrow their own money from themselves in order to buy a piece of real estate, in order to buy their own cars, in order to buy, wedding rings, whatever it is that they might like. Because with this policy, they can loan against their own money and buy anything they want. They're not limited, correct?
Correct. And it's worth noting that, when you get out of college, usually the number one financial vehicle, the first thing everyone tells you to do is to max out your retirement plan, max out a 401k. And considering we're probably in the lowest tax structure we may ever see for basically forever from here on out, there's almost 100% probability that a kid putting in, a 21, 22-year-old putting money into a 401k, they're most likely going to put in a lower tax bracket than they're going to take that money out. And that's, right now, we're in the lowest tax structure. And basically, for most people, this is the lowest tax structure we'll ever see. So for a younger kid making really not a ton of money, the last place I'd want to put them to put money for my own kids is to defer the taxes so that they can take it out in retirement. The likelihood is so high that they'll take it out at a higher tax bracket that it doesn't make too much sense for them beyond the match and the free money that the company might give them.
Correct. So for me and my own children, I see this as a huge benefit. I also see this as a great way to be in a conversation about money with my kids, which is something I personally have focused on probably for the last, 12 years. It's not easy to do, just like it's not easy to teach them to, limit their time online, et cetera, but it's still a conversation that I'm constantly in with my children about the benefits, how to use it, how to utilize money, just like I would be talking to them about how to interact with an employer, how do I, get a job, what do I need to do? This is one of those life skills that I think is important. So what I was going to do is put up on our Facebook page an article that you shared with me, Chris, to give them a little bit more about it. And I've got 3 different options basically to show you all, if you're a 54-year-old woman and you put in $35,000 a year, it would end up being this. If you're a 34-year-old man, I think I put $10,000 a year, and then I did something for the kids, so that you guys can see how it works and how it grows. And the interesting thing one of the many interesting things to me is, one, this creates a retirement plan for us that are entrepreneurs, so that we have a place that we can pull money out from in the future, which I think is a huge benefit. Of course, the tax aspect, it's protected from which is a huge benefit. There's just so many different benefits here that I thought this would be worthwhile for you. Have specific you'd like me, maybe you can read them out if you could see them in there.
I'm sorry, Onyx, you were breaking up there.
Okay. Kathy, can you hear me?
Yeah, I can hear you.
What I'm thinking, Chris, is that we'll pull up the questions.
He's got them there in the chat box.
Okay. Do you want to read the? Okay. Do you want to read them, or can you read them, Chris?
Well, I think the biggest one in here, because there's going to be a lot of people with our age group here, but somebody's asking, for someone that's in their 50s, single, and never had a whole life policy, is it still worthwhile to invest in?
So I mean, I have clients all over the map who are generally implementing this type of strategy, and the numbers change, but the strategy still works, and I always look at, it's worth noting that this is an ingredient, it's like baking a cake. Your retirement and your financial situation is, you're putting a lot of ingredients to create something. And alone, those things mean something very different than what they are altogether. So I think at any age, if you understand how this impacts everything else that you're doing, it could significantly improve your retirement well-being at any age. The numbers might just be a little different, but anything, in my opinion, is better than nothing once you see how it improves everything.
Awesome. Never had a whole life policy. Is it still? So we'll put a way for you all to interact with Chris. I don't know, Chris, if you want to give it right here on this call. And then what I'll do is I'm going to set up something on Facebook. I'm going to put in a couple of examples there so you guys can print it out and see how the policy grows over time. But as Chris said, the money is immediately 80 to 85% of the money is immediately available for you to loan back out. But let's say, and I'm just picking a number, let's say you started with $50,000 and then you immediately loan back 80% of it. You're still making the 4 or 5% on the $50,000 that's been deposited into your whole life insurance account. And then the key to this is the consistency, it's the discipline of each and every year. But I've now personally had several friends whose parents paid for regular life insurance policies. And what I watched is, as the parents got older, the parents forgot to make their payments. And so a policy that they had paid into, not a whole life, but a regular term policy they paid into for 30 years, just vanished. And so to me, this is much more palatable. It's a much better way, component for you all to create some retirement, a way for you to ensure that you've got income coming back. And of course, I have always liked real estate, one, because it creates forced savings, which I think is really great for all of us. And this, like Chris has been saying, is just another tool in your toolbox.
And Onyx,
Kathy, were there more questions in there that we need to ask Chris?
Well, there's questions
Go
in
for
there,
it.
but
Yes,
they're kind of long.
Okay.
if I could jump in, I think
Yes.
it's very important noting that the structures of these things can be structured in many, many different ways. The examples that I shared with Onyx, they could all be tweaked a little bit. Onyx had asked me to show what's the maximum amounts. So I showed a minimum number and then a maximum number to maximize that overfunding. What's important to understand is this is a disciplined product. To me, the difference between success and failure for most people is discipline. And this is discipline. And I always joke and say it's the steamed broccoli and chicken plan. You know, if I ate steamed broccoli and chicken every day for 3 meals a day, I wouldn't be the chubby kid that I am. I would look however I want. Well, why can't I do that? It's because I'm not disciplined enough to do that. And this is a product that if you set it up in a disciplined way, it will be exactly what you want it to be. If you're just disciplined with how you use it.
Correct. Chris, there's a question here about the waiting period before you can withdraw and take out a loan.
So there are a couple of different ways to interact with the policy. In the first year, that's the most rigid year from the insurance company standpoint. As you add money, it's rigid in the first year. But because we put extra money in the policy and we use this paid up addition feature, in essence, I usually go to the bank to borrow against my policy. It's cheaper to use the bank right now than it is to use the insurance company themselves. As long as you can have enough to hit the bank's limits, you can put the money in and almost immediately, if you put it all in at once, start to lend it back out. As a general rule of thumb though, and just a more traditional, normal way of doing it, we usually are looking at year 2 or 3 before we're starting to interact with the policy. But again, depends on the number and how much.
Right, because with each person, Chris is helping to tailor something specific to you and to what works for your rate of discipline. And I don't know for certain, but I imagine Chris has more than the single policy that he got when he was 22 years old, where he put $385 into it. So you can get more than one policy over time if things change, but you want to be sure that you're putting the money in each and every year. So you want to pick a number that's reasonable that you can reach so that you can be disciplined in producing that income into the policy each and every year. Chris, there's another question here that's great. What if the insurance company goes out of business?
So that's a great question.
How do you deal with that? Yep.
So I don't use like Acme, Wile E. Coyote brand for this. I generally use the big household names. The insurance companies that I use are all mutual companies. Most of them have been around for 150 years plus. They all have the highest ratings financially that you could possibly have. And most states, actually all states, have something called the Insurance Guarantee Fund, and it prevents against insolvency in an insurance company. So any insurance company that would go out of business, the guarantee fund would actually make sure that you're whole in that instance. But the companies that I use for this are the big mutual companies, New York Life, Mass Mutual, Guardian. If those companies ever went under, we're going to have a whole lot more problems than it would really matter at that point. Because like Guardian, who I use predominantly, if every single policy holder they have died, they would still have something like $10 billion in cash. So it's the risk is very low.
Yeah, very, very stable. There's another question here about people in their 60s or 70s. And as I recall, Chris, you have to pay into the policy for a minimum of 7 years before you can start removing. Is that how it works?
No, depending again on structure, we have the ability to start removing relatively soon. The problem that starts to become when you start to hit in your 60s and 70s is because the insurance is guaranteed to pay, the pricing starts to go up significantly. Now we might structure that to make the numbers, different and more appealing. But as you start to get up in age, the numbers start to get a lot higher from a cash flow standpoint. Again, we'll work on.
And that's the death benefit you're talking about, correct, Chris?
I'm sorry, I didn't catch that.
She said that's the death benefit. Yes, that's the death. That would be the death benefit.
Yes, that's the death benefit.
So,
starts to go up significantly in value. And again, if we're not so concerned with the death benefit and we're more concerned with the cash going inside of it, then we're able to structure pretty much for anyone's budget and any age, just depending upon, as long as we meet the thresholds of the insurance company.
Awesome. How does everybody get in touch with you, Chris, if they want to contact you?
I actually, on the group chat, I put my email and my cell phone number, and feel free to contact me on either of those things. My company is DeYoung Financial Group in Jersey, and obviously Onyx also has my contact information, but feel free to text, call, or shoot me an email to those numbers.
So
Yeah, I
it's,
don't,
you put it in.
I
Go
don't
ahead.
see it, so I don't think you put it to everyone. You might have just put it to Onyx or something. So if you can retype that back into everybody, that'd be great.
Okay, everyone. Sorry, I didn't know to that.
No problem. And I will put it up when I'm going to put the article for everybody that wants to download the article and read that. And I'm going to put up just the 3 general examples, which was just stuff I picked pie out of the sky. So you all could see a little bit about how the product works. Obviously, one of the advantages with Chris is that he knows how to structure things, because your needs are going to be different than Kathy's needs, are going to be different than my needs. And the key to this product, I believe, is to have it set up in a way that you can be disciplined with it and that it works for you.
Awesome.
Awesome. Any other questions from anyone?
They're asking,
Yeah.
DeYoung.com is your website?
DeYoungFinancial.com is his website. I just put it in there.
Okay,
Because I
perfect.
Googled him. You know me.
And if anyone has
thank you very much.
questions, feel free to just shoot me an email, and I'm happy to just chat, or in general, run some scenarios for you.
Awesome, Chris. Thank you so much for your time. Thank you for sharing your knowledge and your information with everyone. And I will put the stuff up on Facebook as soon as we hang up, you all. So have a beautiful day, everyone. Thank you, Chris.
Thank you,
Bye,
everyone,
everyone.
for your time. I greatly appreciate it.
Thank you.
Thanks for bringing me in, Onyx. I appreciate it.
My pleasure. My pleasure.
Thank you, Chris.
Bye, everyone.
Bye-bye.
Take care, guys.
Thank you.
Thank you, Chris.